Welcome to episode 39 of the Financially Free Journey podcast, and I am your host, Courtney Dyer. What's up, everybody, and welcome back to the show. And hey, if you're new here, thank you so much for tuning into the show today and clicking on this episode and giving us a chance. Just so you know a little bit more about the show really aims to dispel the seemingly complex topic of personal finances, money management, debt, credit, savings, investing, and even retirement. And with all of the different gurus and books, there can be a lot of conflicting information and it can seem very complex and intimidating. And I aim to dispel, those things that could be scary for you, those topics that you could be trying to steer clear from because you seem to not feel comfortable with them. I want you to feel comfortable and confident with your money decisions and to really feel knowledgeable. So that's what the episode is going to be about today. And hey, thank you to everybody, by the way, that has been subscribing to the show and leaving us a review. It is so helpful so other listeners can really find the show and get this content, and that way they can get the help that they need with their money questions. So thanks for taking 30 seconds and doing that. I really, really appreciate it, guys. Also, I do continue to get some amazing questions from all of you, and I have a ton of episodes that I am planning out based off of the questions I got this week. And if you have a question and you want to inspire an episode, you'll stay anonymous, of course. Make sure that you send me an email. My email address is financiallyfreejourneypodcast@gmail.com, just the name of the show @gmail.com. And I do read all of my emails and I respond to everybody. So send me your question. And remember, no question is a dumb question. All questions are good because I love that you guys are taking the initiative and taking control of your money. So let's talk about the money decisions and that we make when it comes to investing. That's what today's episode is all about. Last episode, I talked about how to get started for beginners in the stock market. And that really inspired a lot of questions from you guys about, okay, we know how to get started, the mechanics of it, but how do you make money in the stock market? I don't necessarily understand how money is made. So that was a big question that came up repeatedly this week based off of the last episode that came out. And a lot of you guys just want to know how the heck money is actually made in the stock market. So this is something that can really be somewhat of a head scratcher for investors and typically new investors. The stock market can seem intimidating and you hear how risky stocks are, but you know that investing in the stock market can potentially give you some amazing returns on your money. And this can really be a quandary for a lot of people a lot of the time. People want to get those higher returns that the stock market offers, but they're also leery of the risk that is associated with that. That can be confusing for a lot of people and really prevent them from pulling the trigger, so to say, when it comes to investing. So this episode is going to go over how to invest in stocks when you're a beginner and how to be profitable in the stock market. I'm also going to go over a couple of pros and cons and how you can own stocks and really be smart about it. Now, if you're looking to build wealth and you're interested in the stock market as a way to help you do that, this episode is definitely for you. So make sure you stick around to the end. Please stay with me because this is going to really empower you to take action. And that's what I really want you to do is take action today. So let's first and foremost talk about what stocks are exactly. Stocks are an investment in a company and that company's profitability. A stock really represents a portion of ownership in a particular company. Another name for stocks is equities. And so just want to throw that out there because those terms are interchangeable and you'll see that a lot when you're researching investing. Now, owning stock, even just one stock, makes you an owner of that company. Companies issue stocks to raise capital for various things, right? Like expanding their business, venturing into new markets, or even hiring and expanding employees. The company can use that money for a variety of things, and raising capital through issuing stocks is a great way for a company to raise large amounts of cash and capital. Companies that decide to raise capital by issuing stocks in their company that are publicly sold are bought and traded on exchanges, which is probably another term that you've heard. An example that you may have heard of is the New York Stock Exchange. And this is a major place that stocks are bought and then sold. Another thing to really understand is that you can only buy or sell stocks through an investment firm, like, for example, Fidelity or TD Ameritrade. Think of an investment firm like the middleman that you have to go through to buy or sell stocks on the exchange, like the New York Stock Exchange. So another term that I really just want to touch on briefly is capital appreciation. This is another thing that you're probably going to hear quite often when you're looking into investing. Capital appreciation is where an equity or a stock increases in value. So let's say you purchased one stock in a company and the stock cost you initially $20 when you purchased it. Capital appreciation is when the stock goes up in price, when it increases in value. Let's say in this example, it increased to $30. In this example, you had capital appreciation of $10 on the stock that you originally purchased at $20. This is what we all hope for, and this is all what we hope will happen when we purchase stocks, and this is how you make money in the stock market. This is one of the ways. So here's a prime example. An example that everybody's probably familiar with. Facebook became a publicly traded company back in 2012, and its IPO, or its initial public offering price, was $38 a share, okay? I wish I had bought in at that time. But today, as I record this episode, I just looked up the stock. Facebook is trading a little above $275 a share. So it went from 38 to $275 a share. So let's say that you were one of those lucky individuals that had purchased Facebook stock at $38 a share. And let's just say for round numbers, you invested $10,000 or you bought 263 shares of Facebook. Today, your initial $10,000 that you invested into Facebook would now be worth over $72,000. So in the course of 8 years, your $10,000 turned into $72,000. And that's because of capital appreciation on your investment. Your capital appreciation in this example would be $62,000. So this is just one way to make money on stocks and investing in the stock market. Now, another way to make money in some stocks, in addition to being able to take advantage of capital appreciation, like we just talked about, the company will pay what's called dividends. This is when a company pays a portion of its profits out to the stockholders, the shareholders, you as the investor. If a company does this, and not all stocks do this, but if the company does do this, the stock is called a dividend stock. Now, if you're not only interested in growth or the capital appreciation, but you're also interested in building income as an investment goal, this is when the dividends really come into play for you. Looking at buying dividend stocks could really be a great option. Companies that pay dividends typically pay out dividends on their shareholders, I would say 4 times a year. That's the typical amount of times they pay out to shareholders. And a tip here is if you're looking to buy dividend stocks, make sure that you research reliable dividend stocks and companies that have a long history of paying out their dividends consistently to their shareholders. A nickname for these highly consistent dividend stocks are called dividend aristocrats. So just make sure that you research these companies prior to investing in them. Some of the companies currently listed as a dividend aristocrat is companies like M3, Coca-Cola, Johnson & Johnson, and Procter & Gamble. So a lot of big names. And all of these companies, I looked it up right before I started recording, and all of these companies have over 55 years of consecutive dividend growth and payout. So, that seems as reliable as it's going to get when it comes to paying out your dividends and growth. So let's just say that you invested $10,000 into a dividend stock. And for this example, let's just say you invested in Johnson & Johnson. That $10,000 would get you 66 shares, and the company pays out a dividend yield of 2.7%, or that's $4.04 a share, and they pay that out 4 times a year. So in this situation, you would be paid $266 in dividends 4 times a year. That's a total of $1,064 a year in income. keep in mind in this example that you are still capturing capital appreciation, like I gave you in the Facebook stock example. And in addition, you're being paid that dividend income. So it's twofold. Okay, we are just going to take a quick sponsor break, but when we come back, we're going to talk about the pros and the cons, as well as how to really be smart when investing. So don't go anywhere. Okay, I am so excited to share this episode's sponsor with you, WYLD Gallery. Now, WYLD is an Austin, Texas-based gallery that exclusively features spellbinding, original, one-of-a-kind Native American imagery that really explores heritage, culture, and tradition. WYLD carries a variety of art, including oil on canvas, acrylic, prints, and even posters. Several of the artists featured at the gallery have paintings in the permanent collections of museums like the Smithsonian and the American Indian Museum in Washington, D.C. and New York City. And I went on and I checked out the art, and I am honestly blown away. I found a piece called The Black Sun that is to die for. It is a beautiful pop of color that would look beautiful in my home. And what I love is that WYLD carries art for every budget. And what a great gift for the holidays to give your loved ones a one-of-a-kind museum quality piece of art. The art is honestly mesmerizing, and I highly recommend that you go check out the website at www.wyld.gallery to start shopping for beautiful one-of-a-kind art today. Okay, welcome back, everybody. Let's get into some of the pros and cons that are associated with investing in stocks. Now, a major pro is that unlike buying other assets, like for example, real estate, you don't need a whole lot of capital to get started in investing. And I talked about this on my last episode, and I'm going to talk about it again because I want you guys to take action. You can start your stock investing journey just by buying one share. That share could be $1, it could be $100. It really depends on the stock that you're buying. Another pro that comes along with buying stock is really that potential for the capital appreciation like we just talked about a couple minutes ago. Now, of course, there's no guarantee for the growth, but if you look at the average large company stock return and capital appreciation since the early 1900s, the return on average has been around 10% a year, which is really a great return on your money. Stocks are a great option for long-term savings goals like home down payments, right? If that's going to be several years down the road, or if you have a young child and you're saving for their college fund, maybe weddings that are several years down the road, and of course, retirement. That's just to name a few examples. Now, let's just go over some of the cons to investing in stocks. I would be remiss to not mention any risks that are associated. The main risk that is associated, of course, is that the stock market is very volatile. All of the news that breaks, financials that are released, and regulations that are imposed can really spike or plummet a stock on a day-to-day or a minute-to-minute basis. And because of this constant fluctuation in the day-to-day, minute-to-minute value of stocks, many investors get scared and they sell off shares when they start to go down in value. This is a surefire way to lose money when investing in stocks, and really is an emotional response to watching the stock market. This is really one of the main reasons why you should avoid looking at your investment accounts on a day-to-day basis if you're saving for a long-term goal. The age-old adage here is to buy low and to sell high. But sadly, a lot of people emotionally react and they do the complete opposite. They buy high when everybody's buying and all your friends are talking about getting into the stock market, and then you sell low once you see some volatility and you're scared that you're going to lose your money. And that's an emotional response to investing, and it's the complete opposite of how you make money in the stock market. Investing at the wrong time can completely wipe out your portfolio, and you can lose money if you need to sell off shares or really liquidate cash when your stocks aren't performing very well. So this is why investing in individual company stocks is extremely risky in the short term, and is why you need to look at your long-term investing goals. And not only should you take a long-term approach to investing, but you have to look at diversifying your funds in order to really mitigate the risk that comes along with investing in the stock market. So here's an example of how diversification works exactly. Let's say you invested $10,000 in Facebook, like we talked about earlier, and that was all of the money that you had. That's your life savings. That means 100% of your money is reliant on Facebook's company performance, their financials, the regulations that are imposed on the company, and how it may affect their industry. Let's say a new regulation came out about user privacy that dramatically impacted the value of Facebook stock. You would be completely subject to the stock's reaction to that new regulation. But let's just say that you diversified your investment, that $10,000, by investing only 5% of your money in Facebook stock. Now, only 5% of your money is subject to how Facebook would be impacted. Most financial advisors are probably going to recommend that you invest in an index of stocks to really spread out your funds and lower your overall risk that's associated with each particular company in the index. Investing in individual companies can be risky, and it's kind of like gambling. So it can be very hard even for professionals to pick winning and losing stocks, which is why index funds are typically the recommendation for most run-of-the-mill investors. Now, a lot of people are surprised when they hear that the way that you limit risk is by investing in more companies instead of less, but diversification really allows you to earn higher average returns while limiting the risk that's associated with it, because it's not very likely that all of your investments will drop in value at the same exact time. So I really hope that this helped you understand how to make money in the stock market and some of the pros and cons associated with it. But before we go, I have to say thank you to Mallory Kate Miller. She recently left a review on the show, and Mallory said, "Courtney, thank you so much for widening my knowledge of investing and how to make informed and intentional decisions with my money. Your episodes are right on point, and I look forward to listening to them daily in the car or taking my dogs for a walk. Thank you for making this really important topic less intimidating and more manageable. Anyone reading this, it's totally worth giving it a try. You'll be happy you did." I just have to say thank you so much for taking the time, Mallory, to write that review and your kind words. Again, guys, it really does help to leave an honest review. It helps me create better content that's more meaningful and relevant for you as my listeners. And it also helps other listeners find these episodes and find the podcast. Thank you again for tuning into the show today and really taking the time to leave the review. I am so grateful for all of you and your support for the show. Without you guys, we wouldn't have a show. So thank you. And if you haven't already, make sure you're following us on Instagram. It's at Financially Free Journey, where I post daily motivational tips to help you on your financially free journey. Until next time.